Alright, so now we have all of our interests for the next 3 years. We want to look at the depreciation. This is something else we have to account for, so we'll say less depreciation. Okay, and for this, what we're going to have to do is take the loan amount divided by the recovery period. So those are both given values as well. The loan amount was $300,000 divided by this cost recovery period of 27.5. All right, and I can just pull that across for these. Oh, we're gonna have to lock these numbers down first. All right, now we can pull it across. Awesome. All right, so now we have everything we need. We can we can calculate the taxable income overall, and that's just going to be a sum of all these numbers right here. So we'll just do a sum function again. Perfect. Pull the equation across. All right, and to make it stand out more that that is a total, we're going to underline this right here. Just a little bottom border. We should take out these borders. Perfect. All right, now that we have all of our taxable income, we're going to start with our after-tax cash flow section. Let's get that started. All right, so we'll take our before-tax cash flow from earlier. We made that right up here. All right, so for year one, it's just right here. You can just pull that all across. All right, so we have our before-tax cash flow. We need the tax impact. All this really is the taxable income times our tax rate. This is how much we're actually going to be paying out in taxes. So, all right, we got to find our taxable income. All right, sorry about that. I got a little confused there. I thought I'd accidentally deleted a column here. But we have everything we need right here. So our taxable income, and then we want to multiply that by the tax rate, which was a given earlier. So our tax rate. All right, so we're just gonna take our 33% right here, the taxable income rate, excuse me. All right, so we're gonna need to lock that last one down, but then we can pull that all across, and that's how much we are gonna be taxed for every year. So it'll pull from those numbers right there. All right, and then the last thing is just a sum of the two, but our after-tax cash flow, I'm just gonna put in the abbreviations there. It's just gonna be a sum of the two. All right, and then we can pull that across and make it look nice with a little bottom border here. Perfect. All right, so that's the after-tax cash flow. The next thing we're going to need is the before-tax equity reversion, the BTER. So I'll type it out this time, equity reversion. All right, so the first thing we're going to need is the future sales price. All right, and then this is just going to be an equation where we take the acquisition price from earlier and then multiply that by times 1 plus the appreciation total. So we can pull that number from up here. Our acquisition price, 375,000. All right, times 1 plus our appreciation total for holding period is 10%. All right, and we'll make that money. And then I guess we want to lock that one. All right, that's perfect. The next thing we need is our selling costs. So we're going to be, this is going to be a negative number. We're going to subtract it. So less selling costs, it's just going to be this number times our selling expenses. So we'll do that. And the selling expenses or cost of selling was 6%. All right. So we need Now we got to calculate the net proceeds from the sale. So that's just going to be a sum of these two. We need this one to be negative because it's a selling cost and expense. Alright, and then that'll make the sum go correct. Perfect. Alright, and then next thing we want to do is take out our loan balance. Alright, so less loan balance from the net proceeds of sale, but first we're going to need that number. We need to do a present value function actually, so we'll do PV, and we're going to want to take the rate of 5%, the mortgage interest rate. Remember, we need that monthly, so we'll divide it by 12. We'll take, actually this one's a little bit different. We're going to take the term of 30 years, but we need to account for all the time that we've been paying on this, and that's 3 years into it before we sell. So let's do it like this. Let's do, a parentheses, and then we'll do 30 years minus the 3 years that we've been here. Alright, and then we can close that up and multiply that by 12 to make it annual. Alright, and then the last thing we need is our monthly payment right here. Alright, perfect. So now we got to do a sum of these two, and the number that we get from that is actually the before tax equity reversion. Alright, so we'll just do a sum function. Sorry, this has got to be negative as well. Alright, awesome. And we can put in BTER for that. Alright, now that we have our before tax equity reversion, we need to calculate the capital gain, and then once we have that, we know how much we're going to be taxed on all that, and it'll start looking more like what we're actually going to profit off this deal. So let's do that. So we'll do capital gain as the next category, the next section. The net proceeds from sale, and we've already calculated that, so we're just going to pull that down, equals right here. Alright, and then we need the original basis, and this is just another way of them putting the acquisition price. So let's pull that from up here. That was $375,000. Alright, and then we have we need to subtract the depreciation amount, the accumulated depreciation. Alright, so to calculate the actual capital gain off the sale, we have how much we've paid for it. So now we have to take out how much we've told the IRS that this building is lost value. Alright, so we are going to do actually a sum of some depreciations here. So we'll do this and the sum function. So over the 3 years, that's how much it's depreciated, $10,900 every year. Alright, so I'm sure there's a different way to do that, but I'm just going to do it like that. We have that number now, we know that's a sum. Alright, and then the next thing we need is we need to add back all the improvements that we've made on the property. So plus improvements. Actually, before we do that, let's make this a negative value. Oops. Perfect. Alright, so plus all the improvements. And that was something that we were given actually, but I believe we put in, was it $6,000? Okay, so that's money we've put back in. And the last thing we need is we need to calculate the adjusted basis. So that's just a sum of all these numbers right here. Perfect. Alright, so you can see now the property is actually, worth $348,000. Alright, so now we can actually calculate the capital gain. So the actual capital gain is just going to be our net proceeds from the sale right here minus this adjusted basis right here. Alright, that's how much we'd be selling it for. That's net proceeds for the sale. Alright, so the capital gain would be about $40,000. That's how much we're going to end up being taxed on. That'll be the next section, is capital gain tax calculation. Alright, now we can begin to actually calculate the capital gain tax. Alright, so let's go ahead and do that. We'll have our appreciation portion of it, as well as our depreciation portion. Okay, so what we're going to have to do for this is we'll start with the depreciation because we already have that. So it's going to be right here, 32,000. Alright, and it's already as negative. We can leave it as that. And then we have our capital gain right here. So if this is the depreciated amount, the appreciation portion is just going to be the difference between these two. I'll say plus because this is negative. Alright, so then that's the appreciation portion. We have some givens though. These are how much we're going to be taxed on these numbers. So as you can see, the appreciation will be taxed 15%, so we can go ahead and do that, times 15%, that looks right, and then that times 25%. Alright, and then I'm going to just make that look right. Alright, perfect. And then we just want to sum these two up, and that's our actual capital gains taxes. Perfect. Alright, now we're at the point where we're going to make our actual decision. We need a couple more things though. We need the initial equity, so this is how much we originally invested ourselves into the property. So that's just going to be the acquisition price minus our down payment, or that loan amount. So acquisition price of that minus, we paid $300,000 when we first purchased it. So we physically put $75,000 into this property. Alright, so keeping all that in mind, we're going to get started with pulling some of these other things down so we can just see it all in one place. So we'll start with the cash flows. This is year 1, excuse me, 2, 3. Alright, so the after-tax cash flow, we can pull from right here. Yeah, let's do it like this, equals cool. Alright, and then we have our BTER from earlier, the equity reversion. And that's just for year 3, but we can pull that number right there. Alright, and then we need the tax on capital gain. Alright, and then that's from right here as well. That's how much we're getting taxed. Alright, and it's already a negative number, that's perfect. Alright, so then we're just going to have to do a sum. We don't have any, these are things that only apply to the last year, but we can go ahead and do a sum here. Oops. Equals sum. Okay, and then there, and then this one we'll just do our own sum. Perfect. Alright. Let's make that, there you go, looks better. Alright, and then next what we're gonna have to do is the IRR. So what we're gonna want to do is a IRR calculation, and we have to compare that. That's the initial rate of return, or yeah, no, excuse me. Alright, one thing I did forget to add was the improvements that we made on the property. Alright, because that will benefit us. So we, where should we improve it? Cost of improvement $6,000. Alright, so I'm just gonna put that in. Alright, so now instead of the IRR, well, I guess we do need to know the IRR. So let's do that. Equals IRR. Okay. Alright. Actually, before we do that, we need to make a year 0, and we're gonna be in the hole on this year. But this is how much we've put in. So it's just gonna be a sum of these two. Okay. And that's a negative value. Perfect. Alright. So now that we have all those numbers, we can do the IRR function. Equals IRR of all these. Okay. Alright, so that's our IRR, 44%, and we're going to compare that to the investor's required rate of return, which is 10%. Alright, so let's type that in, required rate of return, and 10%. We can pull that out a little bit. All right, so